I'm Shawn AG, and I need you to pause whatever you're doing right now, because what just happened in silver is not normal market noise. Silver printed $125 per ounce on the Shanghai Futures Exchange. Read that again slowly, 125. Meanwhile, the gap between Shanghai and the Western paper market just blew out to roughly $15 to $17 per ounce. And this isn't some end-of-week headline after the move is over. This is happening right now, only a couple hours into Monday trading in Asia, with silver already ripping higher on the session before most of America has even opened one eye. Before we go deeper, quick housekeeping for the real ones. If you want real-time updates and you want to see what I'm building next for people who actually care about reality, not narratives, join the WhatsApp community. The link is in the description. It's free. Approval takes a minute because we keep scammers and bots out. And I'm saying this clearly. If anyone asks you for money, block them immediately. Protect yourself. No one in my community should ever be requesting payment through DMs. If this content helps you think for yourself, comment OG or real OG so my team knows who's actually here for truth and not entertainment. If it doesn't hit for you, no hard feelings. There's plenty of mainstream comfort content out there. Now, back to what's unfolding, because this is the part most people are going to misunderstand. Shanghai spiking to these levels isn't just a cool screenshot for Twitter. It's a flare gun shot into the sky that says something in the silver market has changed at the structural level. And when I say structural, I mean the plumbing. I mean the global pricing mechanism. I mean the difference between paper promises and actual metal that has to be mined, refined, shipped, insured, stored, and delivered. Here's the simplest way to understand what you're seeing. In the West, the benchmark price most people quote comes from paper markets, COMEX in New York and the London system that influences global bullion flows. Those are huge, liquid markets where contracts trade like financial instruments. In Asia, especially in China, price is increasingly being discovered through a market that is tightly connected to real industrial demand and real physical procurement. When Shanghai is paying $125 while COMEX is hovering around $109 to $110, that spread isn't a rounding error. That's a siren. In theory, a $15 to $17 premium is an open invitation for arbitrage. The textbook says, buy silver where it's cheaper, move it to where it's more expensive, sell it, pocket the difference minus costs. Easy, efficient. Markets should close that gap quickly. But here's the problem. It's not closing fast enough. And that tells you everything you need to know. Either the metal is not available in the size the market needs, or it can't move freely, or the logistics can't keep up, or all of the above. When you see a sustained premium like this, it's not the paper chart speaking. It's the physical world. This didn't come out of nowhere. This premium didn't magically appear in a vacuum overnight. It's been building like pressure behind a dam. Month after month, you've had signals stacking up. Inventories in key Western vault systems tightening, delivery stress showing up in bursts, industrial demand refusing to slow down, and geopolitical decisions turning free trade into controlled flows. Then suddenly, you get the moment where the pressure releases and the market stops pretending everything is fine. Let's talk mechanics for a second, because the mechanics are the story. People love to debate charts, and I get it. Charts matter. But charts are downstream from reality. The reality is, paper silver is a promise, and physical silver is a thing. If I sell you a paper contract, I can do that with the click of a button. If you demand metal, there's only so much metal in registered inventories that is actually ready to be delivered. And when too many people want the thing at the same time, the promises get exposed. We've been watching registered inventories for a long time for this exact reason. Registered metal is the category that is supposed to be readily deliverable against futures contracts. When registered inventories trend down while paper open interest stays high, you're watching a crowd pile into a theater while the number of seats quietly disappears. Every stress event, you see more metal pulled, reclassified, withdrawn, or otherwise made less available. And now Shanghai is essentially stepping around the Western paper mechanism and saying, cool story. We'll pay what we have to pay for actual metal. That's the key phrase. We'll pay what we have to pay. That is not how a market behaves when supply is abundant. That is not how a market behaves when there's no urgency. That is how a market behaves when the buyer cares more about securing supply than negotiating price. Now zoom out and ask the question nobody wants to ask. What happens when the world's largest manufacturing engine starts paying a materially higher price for physical silver than the West is quoting on paper? What happens when the buyers who actually need silver to build products, solar panels, electronics, EV systems, grid components, medical tech, are effectively telling you the real price is higher? It matters because China isn't a casual buyer. China sits at the center of enormous industrial demand. Silver isn't just a shiny asset you stack for vibes. Silver is an industrial metal with unique properties. It's highly conductive, highly reflective, and in many critical applications, it doesn't have a clean substitute that performs the same way at the same scale. You can't just wave a wand and replace silver in high-efficiency solar manufacturing without consequences. You can't just do a quick swap in precision electronics and pretend performance doesn't matter. When industrial demand is real and ongoing, it doesn't politely step aside because futures traders want a lower price. And this is where the conversation gets uncomfortable for people who still believe the Western paper markets are the ultimate authority. If Shanghai can sustain a premium like this, it signals decoupling, not a momentary glitch, decoupling. The physical market in the region that consumes and converts enormous quantities of raw materials into finished goods is effectively challenging the Western paper benchmark. Now, is that automatically permanent? No. Let's keep discipline. But it's serious enough that anyone ignoring it is basically choosing to be uninformed. You're also seeing a technical picture that's screaming momentum. Silver didn't tiptoe through levels, it blasted through them. On shorter time frames, you're going to see momentum indicators pinned. You're going to see overbought readings. You're going to see the kind of velocity that makes people either euphoric or terrified. But here's what's more important. On longer time frames, silver has been carving out a base, a coil, a long period where it looked boring to the mainstream. Long bases tend to precede violent repricing when the narrative flips and when supply tightness meets demand urgency. And here's what most people miss. The money that typically chases silver late in a move, the big Western institutional flows, has largely not been there in size for years. Precious metals were treated like an old story while the world chased tech, chased growth, chased whatever the narrative of the month was. If Asia is already paying up for physical and the West suddenly wakes up and decides it wants exposure, you don't get a gentle adjustment. You get a scramble. You get a repricing. You get a market that tries to find equilibrium in a hurry. Let me give you the scenario that should be flashing in your mind right now. Shanghai is at $125. COMEX is around $110. Western funds see the spread and smell opportunity, or they get nervous about supply risk, or they decide they need a hedge because the world is fragmenting. They start buying paper. Then some of them ask for delivery, or the market starts pricing delivery risk into premiums. Meanwhile, inventories aren't infinite. Premiums in New York and London start climbing. You see backwardation, spot becoming more expensive than future delivery, showing up not as a rare event, but as a persistent condition. That's when you're no longer living in a normal commodity market. That's when you're watching credibility get tested, because paper price only works as the price, as long as people trust the system can deliver the underlying commodity when demanded. Now, I can already hear the skeptical voices, and honestly, good. Skepticism is healthy. You should have a bearish checklist. You should always ask, what would make this fail? Because chasing a vertical move without discipline is how people donate money to the market. So let's talk about the bearish case. What could cool this off? What could fake people out? What could cause a sharp reversal? One possibility is that this is a Shanghai-specific squeeze driven by a concentrated situation, contract dynamics, warehouse constraints, a few massive buyers hitting a narrow pipe at the same time. If that's the case, premiums can flare and then collapse when conditions normalize. Commodity markets have seen flash dislocations before. If supply flows adjust, if metal moves, if the immediate stress resolves, the gap can close quickly. Another possibility is that Western paper markets don't just sit there and take it. They have tools. They can raise margin requirements. They can change settlement incentives. They can halt trading. They can encourage cash settlement if delivery becomes difficult. And let's not pretend this market is a pure free-for-all where everyone plays fair. Silver has a long history of concentrated positioning and heavy influence. That doesn't automatically mean conspiracy. It just means structure. Big players have big influence. If they want to slow momentum, they can often do it through the rules of participation. Third, when a move happens fast, profit-taking becomes a force of nature. People who got long earlier, whether they're traders, funds, or producers hedging, see huge gains and decide to lock them in. A move can be fundamentally justified and still correct violently in the short term. That's the price of volatility. Fourth, macro conditions matter. Silver is not immune to liquidity events. If global markets go risk-off because of a credit shock, a geopolitical escalation, or unexpected central bank shifts, silver can get sold alongside everything else, at least temporarily. Sometimes the market sells what it can, not what it wants to. If the dollar spikes suddenly or yields surge on hawkish surprises, precious metals can catch a headwind in the short run. And finally, the obvious but necessary warning. Silver is a beast. It swings hard. If you're not emotionally and financially prepared for violent moves, you shouldn't be using leverage. If you're trading on margin with money you can't afford to lose, this is exactly how people get wrecked. If you're trying to get rich by Friday, you are playing the market's favorite game. Take your money and teach you a lesson. Now, with all that said, here's why the bullish case is escalating anyway. This Shanghai premium spike isn't occurring in a vacuum. It's landing on top of a pile of signals that have been building for months and years. You've got inventories tightening in multiple venues. You've got industrial demand that doesn't care about your feelings. You've got governments treating critical materials like strategic resources. You've got supply chains fragmenting along geopolitical lines. You've got a world that is increasingly choosing reliability over efficiency, even if that costs more. And silver sits right in the crosshairs of that shift. Because silver is both monetary and industrial. It's not purely a store of value narrative like some people frame it. And it's not purely an industrial commodity either. It's both. That dual identity is why it can move like a commodity in one moment and like money in the next. When inflation narratives rise, when currency trust declines, silver gets a tailwind. When industrial demand ramps, silver gets another tailwind. When both happen at once, the move can be vicious. Now add the strategic layer. We are living through a global race to secure inputs for national competitiveness. Solar build-outs, EV transition, grid upgrades, data center expansion. These are not optional in the eyes of governments and mega industries. These are mission-critical projects. They're planned, funded, and politically backed, and many of them are silver-intensive. Solar manufacturing alone requires massive amounts of silver, and when you scale that across national energy goals, the numbers stop being cute. EVs, high-performance electronics, communications infrastructure, defense applications. None of these categories politely pause because silver got expensive. This is why higher price solves the shortage is not always immediately true. Higher prices can incentivize production, yes, but mines don't appear overnight. Permitting takes time. Capital takes time. Refining capacity takes time. Logistics take time. If demand is rising now and supply response is slow, the only thing that can balance the market in the short term is price, sometimes violently. And this is the part that could turn this from a spike into a reset. If Shanghai is willing to pay $125 while the West tries to keep a lower paper price, that spread becomes a vacuum. Metal wants to flow toward the highest bidder. But if the metal isn't available in the quantities needed, or if it can't move freely, you get prolonged dislocations. And prolonged dislocations are how market structures break, because they force participants to stop trusting the benchmark. If COMEX is perceived as unable or unwilling to reliably settle with physical delivery at scale, then the paper price becomes less relevant to physical buyers. And once that perception takes hold, it's hard to reverse. Confidence is slow to build and fast to lose. Now let's bring this back to you, because most people listening fall into one of three groups: physical holders, traders, or observers. If you hold physical silver, what you're seeing is a kind of validation. The premiums you've been paying over spot weren't just random dealer markups. Premiums are the market's way of telling you that the real-world availability price is higher than the financial reference price. When physical is tight, the premium becomes the truth, and spot becomes a headline number. Shanghai printing a huge premium is basically the institutional version of what retail buyers have felt for a while. Physical matters. If you trade, you're looking at both opportunity and danger. Momentum is real, but momentum can punish the undisciplined. If you're already long, know where your risk is. Know what a normal pullback looks like in silver so you don't panic sell a dip and then watch it rip without you. If you're not in, don't FOMO into a vertical candle like it's a lottery ticket. Wait for structure. Let the market breathe. The easiest way to lose money is to buy right when your emotions are hottest. If you're just watching and learning, this is your moment to study how price discovery actually works. Study the difference between paper and physical. Study how premiums behave in tight markets. Study what happens when major regional exchanges diverge. This is real-world economics, not textbook theory. Here are the 3 big takeaways you need to hold in your head, because this is what matters beyond the hype. First, a $15 to $17 premium between Shanghai and Western paper benchmarks is not normal volatility. It's a sign of friction, either supply, logistics, or market structure. It signals the physical market is under stress. Second, if that disconnect persists, it challenges the credibility of Western paper markets as the global price setter for silver. A benchmark only works if the world accepts it as actionable. If the biggest physical buyers reject it and pay their own price, the benchmark becomes less powerful. Third, the broader backdrop, industrial demand growth, strategic stockpiling behavior, tightening inventories, and geopolitical fragmentation, is the kind of convergence that can force a repricing event. Not a polite repricing, a fast, messy, reality-based repricing. Now, the unresolved tension, the thing you should be watching like a hawk, is how the Western systems respond. Do they allow price to rise and converge toward the physical market? Do they attempt to cool it with margin hikes and rule changes? Do we see more cash settlement pressure? Do we see physical premiums in the West explode to match Asia? Does the gap widen further? Or does it compress as metal moves and price adjusts? Watch registered inventory trends. Watch delivery volumes. Watch physical premiums on bars and coins. Watch whether London and New York prices begin to creep toward Shanghai or whether the world splits into separate pricing zones. And above all, keep your brain turned on. Verify. Cross-check. Don't outsource your thinking to someone yelling confidently on the internet, including me. Use logic. Use numbers. Use process. Because whether this turns into a short-lived squeeze or the early chapter of a bigger reset, one thing is already true. The tension between paper pricing and physical reality is no longer theoretical. It's visible. It's measurable. It's happening in real time. This is not the moment to be complacent. Know why you're in the market. Know your time horizon. Know your risk tolerance. And decide what your plan is before the crowd forces you into emotional decisions. History doesn't always announce itself with fireworks, but sometimes it does. And right now, the silver market is firing off signals loud enough that even people who don't care about commodities are going to feel it soon. Copyright 2026, Shawn AG. All rights reserved.